Welcome to American Building. I'm your host, Atif Kader. Join me as we explore the skylines and strip malls, the crosswalks and rail crossings, the balconies, the buildings, and the boroughs shaping the next generation of real estate. Let's build common ground. Today, our guest is Danny Fishman, founder of GAIA Real Estate. GAIA is an opportunistic operator that buys underperforming and distressed assets and repositions them through hands-on management, targeted capital investments, and neighborhood-driven programming. Today, we'll focus on the Carillon. It is a multifamily asset in Nashville that GAIA acquired as a distressed property. It wasn't built by GAIA originally, but improved. Since the acquisition, GAIA stabilized operations, executed priority capital expenditure work, reset leasing and programming, and repositioned the property to better serve the local rental market. This is a case study in operator-led value creation, essentially a playbook for identifying and capitalizing on distress in Sunbelt markets. So thank you so much for being here with us, Danny.
Thank you very much. Pleasure.
So, Danny, how did you get into real estate at first?
So actually, my first job after school was in Israel, and at that time, was emerging from more like socialist or semi-socialist country to capitalist, and the government had a lot of government companies, owned companies, and they wanted to privatize them. So my first job after business school was I joined this team, and my job was to float companies, sell them, and my sector was real estate. So I did this for a few years. After that, I moved to investment banking, private equity. But then when the crisis happened in the US with the meltdown of the financial market in '08, I thought it's a great opportunity, and I co-founded GAIA. And we started in '09 when there was a lot of distress. So that's in a nutshell, the story.
Great. And diving into that a little bit in more detail, you had mentioned in the move from socialism to capitalism, the type of work that you did for the government in Israel is to sell off government companies. Is that basically the idea?
Right. So the idea was I was with a team of people who were sitting on the board of those companies. And so first stage was to prepare them. So
Okay.
to prepare their books, to prepare their asset list, and to see the real estate, the values. And then in each company, we decided if to sell it in a private sale or and do a bid or take it public and so forth. But the idea was that after we finish this process, everything will be transformed into the private sector and the government will be out of the real estate market.
I see. And that was primarily within the construction industry, within real estate, and then you moved from there?
Yeah, and it was actually in everything. The government back then was involved, so I was on board and dealing with rental companies, infrastructure companies, construction development companies. So the government was involved in everything. So it was like really everything. And and then when the process ended, it ended years after I left because
Sure.
other people continue to do that, but and of course the government is now long ago not involved in the business side.
And what were some of the skills that you learned in doing that as your first job out of grad school?
I think that the first thing that I learned is that the government cannot do things and is totally not efficient. Totally, it always ends with corruption because then the politicians said who is going to be the board and who is going to be the CEO. And then the politician asked for favors from the people on the company. And so that was the first fresh memory after school. It was a little bit of a shock to see it. So I think that from that point, I thought, the government should be involved in the minimum in every sector. So that was the first thing. And the second was a good school because I was young analyst after school, and I was then sitting with teams and, analyzing companies, preparing them for flotation, working with investment banks from the US and Israel. So it was a great experience, and I learned a lot in this in a period of time.
So the financial crisis comes around in 2008, and you started GAIA. So talk to me about that move from Israel to the United States and what the first projects that you were pursuing and how those went?
Sure. So in but by then I had like my own investment bank that I started in Israel that was focusing on capital markets, fundraising, money management, and so forth. And then I met my partner in Israel, Ken Woolley. Ken is the founder and he's still the chairman of Extra Space Storage. It's the largest self-storage REIT.
Okay.
And separately is involved in developing and so forth. So we met and we said that the market looks like a bubble and there will be an opportunity when basically everything will blow up. And then the crisis happened, Bear Stearns, Lehman Brothers. And then we said, okay, that's a great time to start. So
Hmm.
basically, in 2009, I left my investment bank and stayed only on the board and moved to the US. And we started the operation, hiring people. We started in New York. And in New York at that time, there was a big opportunity on the condos market because the development of condos in New York versus like Miami, where I'm now getting this interview, is that when you're buying a condo, you're basically putting a 10% deposit. And then you're coming to the closing with 90% of the money.
Hmm.
So the developer is actually not using your money. So, and if you're late or something like this, you can take the deposit. But also, it's like an option because if the market is down more than 10%, so '09 came and basically most of the buyers just threw the deposit. So you had the brand new condos all over the city that they thought that they were 100% sold. And a few months ago, now there are 0% sales because everyone left. So what we did is we went to the developers and we bought bulks of condos, but all cash. There was no lenders back then.
Sure.
So we bought condos all cash. And then, so that was the first transactions we did. And then we started to buy multifamily in the Sunbelt that was also distressed. And then at the peak, a year later, there was a big portfolio that Lehman Brothers was involved in a mezzanine, and it was like almost 10,000 units.
Hmm.
So we competed on that on the market. It was almost 1 year process in bankruptcy court. And we competed against, the big players, the big private equity real estate sharks of the US, and we won. And we got the portfolio. And that was a game changer for us, for GAIA, because we had now to build very fast, almost all the teams and everything. And since then, we continued to grow until per today, we did almost $4 billion of assets.
That's 4 billion of acquisitions.
Right.
Okay. And you mentioned that from that first step in New York, you moved into the Sun Belt. What were some of the metrics or the things that attracted you to that part of the country?
So we started to buy in Houston, which is a market that we saw the first opportunities. It was growing very fast
Hmm.
and had some distress because Houston it doesn't have the volatility that back then Miami had, that today doesn't, but it still had the volatility because there was no zoning. So every time was oversupply. So we saw an opportunity there and we started acquiring and it went very well. And then we established our own office. And at the peak, we had like 6,000 units in Houston. And I think we had an office with 350 people over there, including the management. And through the acquisition of the Lehman Brothers portfolio, we basically entered other markets because in the bankruptcy court, you cannot choose and pick. It was like one portfolio of 10,000 units. You had to buy it all. So everything with everything, each class A, B, C, every location, everything. So it was one portfolio, you win, and that's it. So with this, we got portfolios in other places like Dallas and Florida and Atlanta and Nashville, in Phoenix, Arizona. And so with this, we expanded and we started to work. And then basically around properties that we had, we started to see different opportunities and expanded. But definitely Houston was a big for us, and then we continue to buy there directly other portfolios after that. And the bottom line is around 21 when
Hmm.
we saw that the market is very expensive. The interest rates was low, cap rates were ridiculously low,
Hmm.
and we just sold everything. So, and exited the market.
So what were some of the lessons that you learned from that first growth phase of Gaia Real Estate?
I think that at the end of the day, real estate is a product. It's not a consumer product, but it's almost a consumer product. So
When you
basically,
say consumer product, do you mean like a commodity?
no, it means that there is a user that wants to buy it and to needs it, right? So our basically customers are the renters, right? The people that rent
Mhm.
apartment. So you can do all day long the models and the Excels and the underwriting, but the end of the day, I think the first thing you need to see is who is your renter pool and what can they afford and what they're looking for. Because that's the basic. And then, when we, for instance, when we bought and after that we sold, a lot of the decision, besides the regular things, the model, the capital markets, the interest rates, everything was that we basically understood that the tenants, that our customers cannot pay more rent. So basically we're saying if they cannot pay more rent because they're priced out, and there's no more really added value because you can play the houses with gold, but they don't have money to pay more rent, so it doesn't matter.
Yeah.
And people were still underwriting rent growth and added value and things like that. And we said, okay, at this point, we better sell everything. If other people believe in it, we don't, and then we exit.
Yep. So then, uh, after 2021, you waited for new opportunities in new markets, and one of those was Nashville. So tell me about how you had come to find Nashville as a potential market and where that learning process went.
So the first property in Nashville we actually bought with the portfolio of Lehman. So that's how we
So
started our experience in Nashville. And for me, coming from Israel, Nashville was, I don't know, country music, things. I did
barbecue.
exactly good barbecue, good music, but and when we started to come there more and more to see a portfolio, we saw a very nice city with universities and healthcare and growing, and young people like to go there. So then we started to explore more the market, and then we saw a neighborhood that was called Germantown,
Hmm.
which reminded me a lot of like Williamsburg in New York, but more central. So basically, we said that's a great place because it's very close to everything. It has the vibe and the hype of young people want, and it still is mixed. So it's not like you usually go to a sunbelt and there's like brand new area that it's all look boring, cookie cutter, multifamily after multifamily. It has the old warehouses and small bars, and people are doing creative things. And among them, they're building a multifamily. So we thought, okay, that's a great opportunity to come to a place. And of course, we did a lot of macro and micro, and we understood that they're about to build there the national library and the museum, and they're expanding the park, and it's only half a mile walking to the downtown, and
Hmm.
more and more things going there. So we focused on that, and we bought this property. And actually, when we sold everything in 21, 22, we kept this one because we thought that even if it's traded today, we could probably sell it with lower cap rate. We believed a lot in Nashville as a city and this area, so we kept the portfolio. And a year ago, we even bought more in Nashville with the oversupply and a little bit distress and the weakness of the rental market. We bought another property there.
So tell us about the Carillon in terms of how you found it. What was the initial opportunity identified?
So as I said, we came to the neighborhood, and the neighborhood was very like cool and hype and
Hmm.
very interesting, and was and it was funny because we are very much hands-on. So when we are buying a property or the due diligence, we're coming with large team, and we are spending a lot of time there, and going in the evening to see how it looks, and staying for the weekend to see what's going on, and early in the morning.
Hmm.
So we are and usually for us, especially that coming from New York, and this, it was like was work. You go to Houston, you finish work, then there's nothing else to do. You just want to go back to the to the airplane and fly back home. And
Sure.
so when we're doing due diligence there, it was the first time that, people started to say, can I stay after that the weekend there? And the teams in New York were like, we're starting to fight who's going to do the due diligence, who's going to fly. And usually the opposite, no one wants to. So, you find a place that it's very nice. It's like maybe the only place where I invested besides New York or Miami, that
Sure.
it's a place that I said, okay, you know what? I would stay here a weekend. I see myself, if I'm after college, I would live here.
Yeah.
And as we said before, when you buy, at the end of the day, it's a product, it's a consumer
Mhm.
product. And I'm saying, if me and the team feel like this, and everyone wants to be there and go there and say, then it means that it's a place that also tenants will want to come and go. And that's was part of the decision.
And then the Carillon itself, what was the source of the acquisition? Was there, distress on the financing? Was it partly
No,
complete?
it was
How
just
did
a
how did it
period
work?
of time that it was completed and was stabilized, and there was more oversupply coming. And Nashville was still not so much institutional like it is today. It was like more
Mm.
like treasury market. So institution today it's like prime market, but it wasn't like this. It's very new. So we could buy it at good prices versus cost and cap rates, and everything looks good, and everything look to us also not taking into consideration all the growth and the changes that are coming around this property. So
Mhm.
just like across the street, places like the National Library, Museum, Park, and it was like for us, it was okay. That's a great opportunity to get in a good price an asset that is also not just the asset per se we're buying well, but it's like in an area that is improving a lot with a significant change. And of course, now if you walk there, you see all these things around you, but it was like they were not existing, I don't know, 7, 10 years ago.
So it was one where you found a particular, opportunity that you saw had high upside, purchased the property, and, were there any renovations or changes or improvements or adjustments that you focused on in the early years?
Yeah, so we utilized few things. They had a lot of parking, and the parking podium ended like in like a rooftop that was more parking.
Mhm.
And it was empty. People prefer to park on the covered one, and the top floor was always empty. No one was using it. And then we saw that, I don't know, 70% of the tenant has pets, dogs. So
Mhm.
we said, why not? So we did like a dog park on the roof.
Okay.
So things like that we improved it, or we improved and we built like a co-working because a lot of those people were working from home. So what we try to do is basically, instead of usually multifamily developers build like in trends. If the trend is now to do game room, they do game room. If it is to do X, they do X. So what we did is we took the property and took the tenants and the neighborhood and I said, okay, what they really need. They have dogs, they work from home. So this is their main two needs.
Yep.
And the gaming room was empty all the time. And I say, okay, it's maybe it was the fashion back then to build gaming room, but there's no one uses it. So it's like, what's the point? And the people are fighting on the conference room who's gonna be there. So that's what I'm saying. We're always trying to see what our clients want, not what we think that in the tower on the 50th floor in Manhattan, the
Mhm.
Excel said that they need.
So in this case, how many units are on the property? How many, floors? Like, what's, like, the massing of it?
It's around 300 units. It's spread around like a swimming pool and a very nice court, two courts like this, and it has all the full amenities. But it's because it's urban, and that's one of the things that we like. Usually, when you go to a Sunbelt property, then basically there's nothing much around it. You need a car to go
Mhm.
every place.
Sure.
So
Atlanta is a perfect example.
exactly in Houston and Dallas and Phoenix, Arizona are all the same. Here it reminds us a lot of Manhattan because you walk out, you walk to restaurants and bars and the baseball stadium across the street. And so for us, it was not just the amenities of, it's like Manhattan, right? In Manhattan, you say, okay, what's the neighborhood? All the neighborhood is amenities for the tenants, not
Mhm.
just the building. So it was the same for us over there.
So basically, it's this idea of selling Nashville. That's it. All the amazing
Nashville and this
aspects of it.
specific neighborhood, because this
Sure.
specific neighborhood has things that worked for us in the past and still work for us in the future. In things that we did after that was that if an area is more walkable and has the combination of work, play, live, then it attracts a lot of young professional and good people because you have everything around you walking distance. At the end of the day, people, definitely young professionals in this generations like that. So it's like it's less that they want to be in a remote place and go
Mhm.
to drive the car to to buy groceries or to a bar. So all these things were falling exactly as how we saw this place.
So from the team comes to see the property, you're making these targeted improvements. You had certain expectations of how the rent would increase in response. In the first couple of years, have you seen your expectations realized or exceeded, or how have they compared?
Yeah, the property always performed better than we thought, and I think everything was basically. I think that we're good managers, but with all the honesty, it's not just us because if the
It could also be conservative underwriters too. So.
exactly so, but it's the area was performing well and specific property in the location that was close to the stadium and close to this and close to that was performing. So it always performed well. Now the value, of course, go up and down with the capital markets and with interest rates and cap rates,
Hmm.
like everything. But even in when there was more distress in the general market, this property performed well and always even by value, not that we sold, was got a good valuation. Not that we sold it or anything, but it's
Hmm.
definitely proved itself as a good property.
Did you buy this one all cash as well?
No, we bought it with a loan, and then after that we refiled. And then when we sold everything, we thought that this one we were not selling because we could get a very good price, and there was a huge demand, and
Hmm.
you can already see all the parks and everything around it, the museum. But we knew that it's becoming like one of the top hubs for healthcare because of Vanderbilt and other things. And then we
Hmm.
understood that there is a plan for Oracle to move their headquarters just across the street from us. So we thought, okay, that's one that we're
That's
gonna
a game changer.
exactly. So that's one we're gonna keep keeping, not selling.
When is that headquarters going to be realized?
It's already happening there.
Oh, it's there. Okay, it's in
It's not
process.
there, but it's in the process, and but now, of course, it's really and it's like 6,000 jobs, so it's like it's very significant.
Do you anticipate then a change in the renter profile, increase in potential rents?
I think rents will increase definitely because it's all improving and naturally improving. And also now there is oversupply that we knew, not in this area, but general in Nashville, there is oversupply. That's one of the markets that were, you know, overbuilt because of all the
Hmm.
growth. And we expect everything to be absorbed, 26. And we think that the end of 26 we'll start to see back rent growth for sure in this submarket as well.
So now, as you look into next phase of investment, there's another interest rate drop this week and likely going into the first quarter of next year. What markets in the Sun Belt are you interested in, or beyond the Sun Belt?
So we are very, very focused on South Florida.
Hmm.
And we're doing some different strategy. We're basically locating neighborhoods in South Florida that are center, like urban, not suburbia, that basically still didn't emerge or gentrified.
Hmm.
So many single homes or others. And basically what we're doing is we're buying, focusing on specific neighborhoods, buying a lot of volume in this specific neighborhood and and helping the change happen with new product and adding more cool retail and cleaning the neighborhood and so forth and so forth. So that's our focus now. We believe a lot in South Florida. I think that it's you take all the area from Miami to West Palm, we think that there will be a lot of growth there. We think that will be definitely one of the winning metros in the US from all the
The
changes.
population.
population growth, but it's not just population, because you see Houston is growing and Dallas is growing, but it's also there's a lot of wealth going there. So and a lot of hedge fund and tech and finance and so forth. So it's population growth, but also wealth, and they're run very well as a state in trying to cut red tape and working with business and landlord friendly and also very business friendly. And of course, there's no tax, which
Hmm.
attracts a lot of business and high net worth. And on top of it, we continue to see all the issues that are in the Northeast and other cities that basically causing businesses and the wealthy people move out. And this is before next week elections in New York. So we believe a lot in this metro. And also, Miami used to be like La La Land, like playground. You're coming for vacation. And since COVID, it's starting to get a volume of other things slow, like, culture,
Finance.
business, and finance, and, art. And so it's becoming a city over that people can, and West Palm is the same, and Fort Lauderdale is the same, and Boca, like a place that you can live around year or long and have everything that you need from entertainment, art, culture, things like that. There's still, of course, a lot of things that they still need to do and build,
Mhm.
but it's going in the right direction.
What would you say are the main reasons that you would have concern on investing in the Northeast? So it's high property tax, high income
In New
tax,
York, you mean?
um, New York specifically, but I didn't say Philadelphia, Boston, other
So
Northeast
first, I
cities.
think that the city in general is not business friendly. So it's to some degree they take because of the political environment. They look at business owners and landlords and general like they are the enemy.
Enemy?
Instead of red carpet, they will do everything that they can to slow you down. Tons of red tape, like ridiculous things, that hundreds and hundreds of regulations and laws and inspections that doesn't contribute to anyone. So,
Give me one of your favorites that are your point of consternation
all right, I'll
for New
give you
York
two.
investments.
There is a shortage of apartments in New York, right?
Mhm.
Okay, big shortage, and the rent is growing not because there's so much demand, because there's no one wants to build.
Lack of supply.
Right. So you finish renovation of new apartments, everything good, everything is new, ready for a tenant. Takes the inspector 1 month to come. So okay, so all the units sit 1 month on the apartment on the empty. Inspector comes, everything is fine, everything is great. The painter that painted the door from the outside forgot to put back the unit number 1, 2, 3. Inspector says, sorry, you failed the inspector. Call me, I'll come again in a month.
Next month.
No, in 1 month. So another 1 month, everything is vacant, just waiting for us to put the number on. Another example, they just passed a law that if you need to install a new washer, dryer, you need like a super plumber. I don't know what's the definition. There's maybe 2,000 of them like in the city. So
Mhm.
like to install a washer that costs, I don't know, $300, $400, it costs you $500 and you have to wait for this expert and for nothing. There's no reason. And then they say why the cost of living is so high. So it's like, and
Mhm.
that's examples, but the day to day is like this. So it pushes investors out, it pushes developers out. On top of it, there is high taxes and,
Mhm.
and a lot of issues on the streets and crime up and down and things like that. So you say, okay, there are other places that I can work, calmly, and people understand the value and work with me. And the city improves things. And to be a landlord, they changed the law of eviction in New York. So, people that know to walk the system. We had a tenant that was totally white collar in a free market apartment. We could not evict him for 2 years. So the guy, sit basically, and we have a lot of landlords that are in the same situation. So basically, it's very hard to operate, and that pushes the people out of the city.
And did you have or have you had investments in Northern New Jersey, Philadelphia, Boston, other DC markets like that?
We had the properties in Jersey and we sold everything. And in the Northeast, we still have in New York, of course, in Manhattan.
Sure.
We have in Stanford, Connecticut, a few high rises, which are doing very well and it's a nice market. And we have another big property that we have and also performing well in East Providence in Rhode Island.
Oh, okay.
So that's our footprint today in the Northeast. All the rest is in Sunbelt and South Florida.
Um, the other markets that you mentioned in the Northeast, do they have those properties have similar kind of issues that you described as to the New York opportunities that you have, or those
No,
are a little
they're
easier?
harder than to operate in the Sunbelt, but it's
Sure.
not even close to the nightmare of New York.
I'm guessing then, as you were describing, you are waiting with anticipation for next week's election results, which will be
Yeah,
out by the
yeah,
time
yeah.
this
I
this
hope
is
he will
recorded.
not be elected, this guy, Mamdani, but as I say to people, if he's going to be elected, the question how bad it will be, not if it will be good, if it will be a total disaster or half a disaster.
Have you had a chance to meet Zoran Mamdani?
No, but I was on one, I think it was an online something, and I heard him speaking. I heard him speaking many, many times, and it's like,
Mhm.
it's unbelievable that, the, capital of capitalism in the world and, a city with a very big Jewish community, someone like this can be the mayor.
I had a chance to meet him at when he first ran for a city council position from Queens at a watch party for Super Tuesdays. So Super Tuesday is the day in March where like, I think 17 states have their primaries. So that was was working at a nonprofit in community organizing, and that was his uh, very first role that he was running for. And I found him to be very, very personable, very charming, very thoughtful, very good listener. So hopefully some of those skills will help him navigate the waters of actually running a large city like New York then.
Right. Hopefully he will not be elected, but if he will be elected, hopefully he will be more moderate than he says.
Exactly. So now looking back into the Sun Belt, which is your area of focus, as we know, what are some of the potential upsides that you're looking for going into 2026 and beyond? Particular events, areas, or things that you're looking forward to?
So I think there is, generally speaking, oversupply that
Hmm. Across
basically
the Sun Belt.
across the Sunbelt. There are some pockets with much more and some pockets with less, but generally speaking. Um, and I think that that causes the market to be soft. So basically,
Hmm.
rents are going down and developers that are leasing up offering 1 to 2 months concessions. But on the other hand, if you look at the pipeline, it went down a lot because the interest rate. First of all, if you take an underwrite land today, it almost doesn't pencil out anywhere to build because of the high interest rate and high construction costs. Then basically, so and also developers have hard time to get loans and they're expensive. So the pipeline went down a lot. So, but the growth continues. So our expectation is that it's an opportunity to buy properties that developers or investors need to sell because they have hard time with the loan, with a high interest rate, they cannot refi or whatever. And then basically we think that second half of 26, we believe that things will be stabilizing and rent will start to grow again. So I think that's generally, of course, each pocket is different and each pocket need to be
Hmm.
underwritten. What's the pipeline, what's construction and everything. But generally speaking, this is our assumption.
And
And
are you thinking? Oh, sorry, go ahead.
so, and also the interest rates, they went down. It's not just the cuts, but because we borrow today, we're just now doing a transaction, which probably the interest rate will be a little bit over 5, but around 5%. This was 6.5 a year ago. So it's not just the Fed
Big
cut.
difference.
Exactly, because it's not just the Fed, it's also the spread went down and there's more competition. So basically, it's totally different environment to finance a property at 5% versus 6.5 or 7%.
Especially if you believe in the long-term thesis, that you described about, distress in US multifamily markets. It's usually local and it's temporal. So if you can take advantage of that, particularly as new entrants come to the market for debt, so it's not just community and regional banks that can provide financing for local properties like the ones you're describing,
Right.
then that's downward pressure on the interest rates. So it makes sense to take advantage of that.
Right. You know,
Um,
it's 2 years ago when we looked at things, you could get 50% loan at 7. Today you can get 70% loan at 5.
I've
Huge,
yeah.
huge difference.
And in the markets in the Southeast, the Sun Belt, people talk about Atlanta, Houston, Charlotte, Miami. What about places like Birmingham, Chattanooga, Savannah? Or any of the secondary areas have you had exposure to through pasta?
We used to have a little bit, but we don't invest there. We look mainly on the big metros, big cities, and around them, but we don't go out of those places.
Mhm. I'm guessing it's, easier to fly in and fly out because you prefer not spending too much time there, so those are a little easier.
Yeah, easier to
Um,
find flight and also easier for someone that is like, I mean, we are local in Miami and we're local in New York. So
sure.
every place in South Florida or there, we will know to tell you. But, when you go to Atlanta, more or less Atlanta, you go to some very remote area, you need to really know very, very well the specific area to understand. And it's very hard for a company that is based in Miami and New York to really to get into all the small details and small things. So we prefer to be in places that, it's easier for us to check unless we are really
Mhm.
locals and then we can check everything.
I think in particular, I had a chance to visit Fayetteville, Arkansas, which is buoyed by University of Arkansas, and the Walton family and Walmart in general are the biggest drivers. I would say I would imagine some of the danger in smaller markets is that your growth is tied to like one or two things as opposed to several dozen things.
100%.
Um,
That's another thing that, when you're in center Houston or in Orlando, then you have a lot of job drivers, a lot of this, and we don't want to be in a place like, I don't know, tomorrow morning AI and robots replace 75% of the people in Walmart. So what do you do with this town?
Totally. I would just go watch some football, I guess that's really all you can do, and eat some barbecue. For folks that are looking to, grow their portfolio with, a lot of froth and volatility continuing into next year, what would you say are some of the best learned lessons that you've, learned so far that you're gonna be utilizing in the next couple of years?
So one is one that I said that basically you have to
Mhm.
understand your tenant profile and what they are looking and
That
also
makes a lot of
what they
sense.
can afford to pay. So
Mhm.
when you're underwriting, I think that's the first thing to see if the rents that you're underwriting is realistic or not realistic. So that's one thing. And the second thing is to see that the specific micro location fits the demographics. So
Mhm.
basically, if you have a properties with large units and expecting, to have families and there's no good schools around it, then or
Then
if
what are you doing?
exactly, or if you have small apartments like in cool area, but you have to drive 15 minutes to a bar, then it's also not a fit. So I think that it's the combination of what the tenant can pay and want to pay and can afford, and also what they're expecting to have in the property and around it. So I think that's very focused on the client itself. So I think that's the one lesson that we learned. And I guess that's the main one. And second one is like on the financial modeling and underwriting them to be more realistic, I would say. So basically to say, okay, to lower the expectations and, not to get into things that are very easy to, because Excel, you can put whatever you want. When when we sold the properties in 21 and 22, at the beginning, we sold more than 20,000 units.
Mhm.
So, and everyone was buying. So, after we sold the first, the second, the third, I started to say, okay, maybe I'm wrong. Like, what's going on here? Like, so we had 100 buyers, 150 buyers coming and we're selling. And then saying, what, maybe where something is wrong. Maybe we don't read the map well. Maybe there's something else that they don't see. So we started to basically build underwriting models like we're buying, just to
Mm.
understand, like, okay, I would tell the acquisition, show. So tell me, okay, convince me why to buy it at this price. So, go in with your imagination on the Excel. And I
Yeah.
think that that was a point that we understood that we're probably right and we should sell everything because we could not find something that is reasonable or conservative that can justify that.
It was hocus pocus math?
It was hocus pocus and very unrealistic expectation on how much you really can add value and how much you can really increase the rent by renovation. And I don't know, because interest rates were low and also it was after a lot of years of rent growth, and I guess people assume that it will continue and did not understand that, a blue collar, worker that works in the Houston airport and makes $65,000 a year.
He's not making $100,000 next year. That's not how the math works,
Exactly.
right?
And if you put new kitchen and new everything, it doesn't matter. He can't pay. He needs also to eat. So it's like, so I think that's what the best lessons.
So at the end of interviews, you like to ask, what are you looking for more of? Any particular types of deals that you're looking for?
So I think we are looking more in South Florida for areas that we can change, that still didn't go through the growth and gentrification, and also land that, because it doesn't make sense to build today, but it does make for us sense to buy land and sit on it for the next cycle. So I think that's our main two focuses.
And for folks that may have either, what would be the best way for them to get in touch with you?
Best, email me. We're returning everyone the same day.
Excellent. I love it. So thank you so much for your time today, Danny. And I appreciate you talking about your path in real estate, your strategy at the Carillon, and your thoughts on the market in the next year or so.
Great. Thank you very much. It was a pleasure. It was fun.
Of course.
Thank you. Bye-bye.
I'm Atif Kader, and thanks for joining me on American Building. If you enjoyed this episode, be sure to subscribe on your favorite listing app and leave a rating and review. America's housing crisis is one of our greatest challenges, but what are the real solutions? Hear from the developers and other industry experts driving meaningful change. Get our exclusive guide, Housing in America: 8 Ways We Can Solve Our Way Out of a Crisis, at AmericanBuildingPodcast.com.